Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Francisco Martin-Rayo, CEO of Helios, John Rogers, Chief Data and Analytics Officer of Cotality, and Kamil Kluza, co-founder and COO of Climate X. We're here to discuss identifying, quantifying, and mitigating physical climate risks across multiple sectors. It is great to have all of you with us. Welcome to Trade Talks. Francisco, let's kick it off with you. Give us a brief overview of where the company sits within the climate ecosystem.
Absolutely. So Helios Artificial Intelligence predicts the price and climate risk of 75 commodities across 90 countries. We also have a multi-agent platform that allows you to ask questions like, when should I buy this commodity? Where should I buy it from? How much of it should I buy, et cetera, et cetera.
And John, a Cotality, tell us about that.
Yeah, sure. So we're a property and location company. So we understand everything that's going on in the US. So in the climate space, we understand the financial impact of climate to every single structure up to the year 2050. And just to give you a little bit of context, today's high risk properties is about 12% of the housing stock. That's equivalent to about $4.3 trillion worth of reconstruction costs. If we do nothing and roll forward to 2050, those figures become 20% of the housing stock and about $7.2 trillion worth of reconstruction costs. So you get the business case, the financial number, how to make it more resilient.
Yeah, it certainly is a lot to wrap your head around, and we're actually going to dive into that in just a moment here more deeply. Kamil, give us an idea, Climate X, what's the work you're doing there?
Sure, absolutely. So we're a global resilience data and analytics platform. We help banks, private equity, and commercial real estate understand what the cost and revenue impacts of the weather volatility are. Once that's done, we then help them optimize CapEx and how to deploy it to prevent those, and at the same time reduce the cost of insurance premium. We do that both at an asset and a corporate entity level.
Yeah, and which is so interesting because we're talking about different types of sectors here, but it all comes back to how we're leveraging data to assess these risks, help to mitigate and plan for it appropriately. I'm sure a lot of that is attributed to the demand that we're seeing from emerging technologies. But from Climate X's perspective, what are some of the unique climate risks or impact to your respective space?
Well, I think one of the things that's currently been happening has been the withdrawal of some of the funding here in the US, which can sort of lead to mispricing of the risk. That being said, we know that there are multiple other international agencies like Network for Green the Financial System or Intergovernmental Panel on Climate Change. These global institutions are continuing to double down on on sort of exploring and understanding what the physical risk might do to us as and the businesses. In addition, I guess there could be potentially challenges when it comes to mispricing the risk associated with climate. Obviously, I do believe strongly that the market discipline and the competition are by far higher incentivizer, if you like, when it comes to this. We just saw this month couple of European pension funds dropping the non-ESG funds, like with some of the mandates going as far as 17 billion.
Yeah, which is interesting, John. As I mentioned before, I think the surge in demand for emerging technologies such as AI, as an example, really has helped to re-accelerate the climate conversation because we do need to supply this demand, but we have to use a number of resources and be able to model this risk out. Tell us how predictive modeling is going to help us to get there and manage risk and manage compliance as we emerge through this technology environment.
So we're using supercomputers and AI to understand the financial risk both today and up to the year 2050 for all major hazards. So think about wildfire, hurricanes, and storms. And again, just as you understand the financial number, what is sometimes, unfortunately, an over-politicized subject, flies out the window and you focus on the business case and the financial number. And then like I'll take an example in California, we're helping making homes more resilient to wildfire as stipulated by the Department of Insurance, which has 13 resiliency factors, like your fence is 12 feet away, there's no flammable material within 5 feet, a certain type of roof material. We can identify that using image analytics, send a signal to you, Jill, and your insurer to actually reduce your insurance premium and make your home more hardened to wildfire. So we want to lean in and try and protect, the $50 trillion asset class, which is the US residential real estate economy.
Yeah, so it sounds to me, Francisco, that rather than policy mandates, the actual demand and what the market is driving is allowing this conversation to advance forward.
1,000%. And I think exactly what John said. One of the most exciting parts of where we are today is humanity, really, is the level of innovation that you're seeing in artificial intelligence is completely unprecedented. And that means that you're able to get a level of custom insights at scale that was impossible to even conceive 6 months ago, 12 months ago. And you're able to start making better and better decisions. You're able to get ahead of some of these risks. You're able to mitigate these risks. That, I think, is the most exciting part of where we are today across all of the different industries we work in.
Yeah, which is interesting because when we have these conversations around how to leverage AI and emerging technology in general, it's no longer where you can sit and wait and see if the technology is proven. It's something that you need to deploy to stay ahead of some of these risks.
Absolutely, yeah. And the fact that you can engage with it using natural language is wonderful from a really democratizing perspective, right? It used to be you had to be a really good data scientist or a really good coder or learn how to do Python or C++ a long time ago. That's no longer the case. As long as you can, write sentences in English, Spanish, Ukrainian, et cetera, you're able to get some of the best insights from artificial intelligence. That's totally revolutionary.
Yeah, and looking at, I'm looking over here when you think about from the real estate perspective, you're working with real estate agents, appraisers, home inspectors, and so forth. I think this technology can also be leveraged to remove the silos when it comes to data sharing, risk mitigation, and compliance, and so forth.
1000%, Jill. So imagine we're capturing the digital twin of every single structure in the United States. So that helps a real estate agent, put together in a couple of minutes their listing. Helps an appraiser do their job, faster, smarter. So really, our job was to make them AI superheroes. So be able to use, their cell phone to capture 3D models. We use satellite and aerial imagery to get the external property condition. And once you understand the external and the internal property condition and the changes over time, that just drives all behavior sets and markets, basically. So it's it's an exciting time.
It certainly is. And Kamil, you had noted that it does impact economic stability or instability. How does this relate to the macro environment?
Well, that's a big question. If we think about the pricing of the climate into the global economy, we know that if things are left unchecked by the end of 2050, probably there will be $1 missing from each of our wallets out of every five. So the 20% of global GDP of economy might be wiped out. I think with a bit of a deregulation here in the US, there's definitely a strengthening of the regulation in Europe and Asia as a bit of a counterbalance, as I was trying to allude to earlier. I do, however, believe strongly that the regulation isn't a solution. It's more of the democratizing of the market discipline and the competition itself. So as to the impacts on the global economy, I'm probably less worried because even thinking about our own pipeline and the activity that we do with the customers, every single wildfire that takes place and every single flooding, whilst that's sad, we do have multiple more calls and sort of demands for our intelligence.
So it sounds to me, Kamil, that it's going to require public-private partnerships, not just the private sector or the public sector that's going to execute. Because 2050, it's not that far away. Some of these goals are quite lofty. And as we know, climate projects are capital intensive. They're time intensive, so it's going to require more than just public or private.
Absolutely agree. I was just at the one on Monday, and we're discussing the impact of resilience and adaptation financing. Historically, the public financing has been predominant in the space. If you think about building things like river levees, flood defenses on the sea, and so on, these were typically large infrastructure government projects. However, I think we need to move into the private financing as well, which the commercial real estate space has been doing really successfully for the past few years. And I think as a result of that, there's also an emerging market of blended finance, where, for example, the public and private finance comes together in the light of adaptation needs.
Yeah, we're certainly seeing that with the larger tech companies making those types of investments into different areas of energy. And I think that will be interesting to play out as well in the absence of policy framework. Francisco, though, we also have to think about the communities that we operate in and what the cost to the consumer is going to be. What are your thoughts around that?
It's a really difficult time to be a consumer in general. I think what we're seeing right now is a triple whammy, a food consumer, right? Where you're seeing inflation and tariffs and the impacts of kind of climate change and weather, changing weather impacts. What's interesting is the analysis we did found that about 50% of food inflation is actually tied to some of the climate change that we're seeing generally. And that's something that's only going to accelerate over the next 10 to 15 years. If we were to look at it in a more optimistic sense, the hypotheses that we had 10 years ago have finally started to catch up with reality. And so I think you are starting to see a real impetus to say, how can we help a lot of these growers? How can we help a lot of these procurement teams, a lot of these retailers get ahead of some of these risks so you don't have 100, 200%, price increases driven by these climate disruptions? How do we get ahead of those risks more broadly?
Yeah, which is interesting because we had a company on yesterday where they were talking about saving on air when packages are shipped out. Think of any shipping company and you get all these bubbles and so forth, and you could save anywhere from 15 to 20% of packaging. So it really, not to call it low-hanging fruit, I don't like that term, but there are near-term steps that could be taken as well, which brings me to my question to you, John. Are we leveraging existing resources in an appropriate way, or is there too much wheel reinventing here?
I think we're heading in the right direction in the real estate space. There's lots of good things happening on the ground within various states and cities across the United States to make our housing stock more resilient to extreme weather conditions. And we also measure the change over time. So like we can see that, like Gaston County in Florida, which is closer to the coast than say Seminole County in Georgia, they actually have a lower risk in Florida because their building codes are enforced, mandated, and we can measure the improvements over time so that they're all resilient to floods and high winds. So they've got double fastened roofs, they've got certain types of material types. So you see the improvements over time, and then obviously with the insights that we can provide and measure the differences over time, that really changes the behavior sets. So yeah, I think it's positive things happening on the ground a lot in a lot of places across the US.
Yeah, I think, John, also when it comes to infrastructure, we'll use real estate as an example, thinking about building it for sustainable purposes as well as adaptability, right? Yep. I think with some of our older infrastructure that has perhaps been overlooked, and I think that needs to be part of the equation. Do you think this could also help with housing affordability, or are those two separate issues?
Yeah, so we're there's a lot of pressure on attainability right now with property taxes and insurance premiums. Obviously, insurance premiums being a hot potato in the US, unfortunately, right now. So obviously, making homes more resilient brings down insurance premiums. We're just releasing an insurance premium forecast as well, which will be like similar to the home price index, the pulse of the market. And again, that helps all of the constituents from lenders to insurers to homeowners understand how to build more resilient homes in the future and make things more attainable. So more work to do, but I think we're heading in the right direction.
It's interesting, Kamil, I see in your notes here as well that you're, working with banks for identifying, quantifying, mitigating the risks and so forth. And that also, you have to get the buy-in as well, right? So communicating appropriately to management, the board and so forth. Overall, how do you think boards, corporates are responding to this?
I think where banks and the boards are today versus what they were 5 years ago is quite different. I think what we're seeing is that banks have evolved from somewhat a teenage stage of thinking about physical risks to adolescence. So I think they broadly get in the gist of things that are happening. I think they acknowledge the commercial reality and the returns of things like adaptation, for example. And I think they started to ask more sophisticated questions. So things about asset vulnerability, supply chain mapping, things about the adaptation measures and so on. So I think the conversation is evolving irrespective of the political backdrop. Also, I wanted to flag one sector or aspect of the capital markets. We've seen recently private equity racing ahead and sort of catching up and nearly overtaking the banks in terms of their understanding of physical risks. And quite frankly, some of them are becoming the front runners in the space. So in other words, yeah, we definitely see the pipeline and the activity growing quite exponentially here in the US now. And the New York Climate Week that we part of at the moment is definitely filling me with enthusiasm and optimism.
Yeah, we've certainly seen that throughout our coverage, not just this week, but climate tech in general. I think part of it is some of the subjectivity has been removed from it, and now there's actual data to measure and benchmark with the investments that are being made, and to everyone's point here, more predictive modeling and so forth. I think that's a key part of the story as well, Kamil.
Oh, absolutely. And may I just add that I think right now there's a global consensus of 98% of scientists around the world that climate change is happening and it's going to cost us nearly, the 20% by the end of 2050, as I mentioned earlier. So right now the scientists, the non-climate denier scientists have managed to convince the other percent, and we are here where we are.
I think, Jill, exactly to that point, right? What's nice is the conversation has gone from sustainability is a nice to have. These climate investments are a nice thing to do, and they're seen as costs. And I think the conversation we've seen in Climate Week, especially today, is much more around these are just investments that we need to make in the resiliency of our business going forward. And we're starting to see the ROI across the full supply chain. It's just a really nice way to say this is a market moving mechanism rather than just kind of a nice nonprofit thing that we're part of. It's a dramatic, re-understanding of how we were talking about it.
It certainly is, and I think the energy demand, I think, is a big part of that conversation as well. And again, removing some of the arbitrary nature of it and having the data to be able to measure it. And I would also posit that this will become part of the competitive landscape, just like cybersecurity as an example. It's not something that you have to have, but it's now becoming a competitive measure. I think you will start to see some of these technologies that we've been discussing here part of the competitive equation as well.
Absolutely, yeah. It just becomes the cost of doing business, right? And it just becomes another line item that you're able to track and really see how successful it is against some of the other investments that you're comparing it to.
And Jill, if I could just add, we help a lot of commercial companies in terms of site planning, and it's part of the equation now about understanding their risk to weather events, both today, 5 years from now, 25 years from now, and make sure that they're choosing the right location in the United States and understanding everything from how chronics move, like heat wave patterns, precipitation patterns, and so forth, because they want to choose the right area and make things resilient.
Yeah, it is encouraging to see how the conversation has advanced in just a short time. Appreciate all of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.